Hello, this is a special episode of the TreppWire Podcast, a European update for the week ending March 4th, 2022. I'm Andrew Jacobs, head of structured finance at Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Vivek-Anand Dattani, global head of our structured sales, and Andrew McClymont, structured finance analyst, who is also responsible for our daily CLO TreppWire, which I hope you're all reading regularly.
Thanks, Andrew. Andy and I are excited to be here. The loyal listeners may recall that I have been on a few episodes, but we are very excited to have another dedicated episode for the European market. So your feedback is greatly appreciated.
Absolutely. So let's start with one of the more major topics right now. In recent weeks, all the attention has turned to Eastern Europe amid the crisis in Ukraine. So starting there, let's discuss this on a macro level. What are we seeing, Vivek?
Absolutely. I mean, it's obviously a terrible situation, and our thoughts are with everyone impacted by the war that's happening. And it escalated significantly last Thursday into a full-scale invasion of Ukraine. And just to put it into perspective, it's Europe's largest land war since 1945. And as of today, we're seeing more than 666,000 people who have fled Ukraine. So what sort of things have been happening that are having an impact on the financial markets? Germany have frozen the development of the new Nord 2 gas line. And to put that into perspective, currently Europe relies on Russia for around 40% of its LNG, its liquefied natural gas.
Yeah, I think what's crazy about the Nord 2 gas line now being frozen is it's a $15 billion investment, and it's been split by Gazprom and Shell. And it's meant to supply with Nord 1 25% of all gas to Europe. So it's going to, even though it's not running, it's going to have massive implications on development costs and future impact on supply chain.
And it's interesting because we're going to be talking about companies divesting its Russian exposure, and Shell is one of those companies that was in the news today. So how that impacts the gas line, only time will tell. I mean, supply fears have also raised the price of gas and oil. Oil has risen to a high of $105, with the LNG futures up 50%. The stock market's been impacted. We've seen the S&P tumble, we've seen it recover, we've seen the MOX drop. We'll go into a bit more detail later on. The European Union, Great Britain, the United States, and other Western allies announced that Russia would be excluded from SWIFT. SWIFT is the international banking system, essentially making it impossible for the Russian central bank to move around their funds on the foreign exchange market, and much more. And what this has meant is the Russian central bank has increased its interest rate to 20% from 9.5%. And the ruble, the Russian ruble, has weakened nearly 30% since Friday. As I mentioned, be it Shell and BP are just two examples of divesting Russian assets. Some of this may be forced by the local governments. Others, they've come out with pretty strong statements. We're seeing rating agencies putting many Russian financial institutions on review for possible downgrade. And what I'm really intrigued is how the Bank of England and the Fed are going to tackle the issue of rising inflation with their planned raised interest rates. And of course, now the impact of this crisis.
I think what's also very interesting with the fact that Russia's being moved from SWIFT is not only means that they can't be moving money to the foreign exchange, it also means that people can't pay them. So in the market, companies such as Gazprom have actually been excluded from the SWIFT sanctions so that the European Union can still get paid.
So narrowing it down a little bit, what is the impact to some of the markets that we're focused on? Corporate CLOs, CRE, CMBS?
So I think the initial impact and the initial concern that everyone had was that Russia would cut off the supply of oil and natural gas to Europe. Now, as mentioned, they're supplying about 40%. So if they cut this off, we're going to see significant increases in inflation, which have a knock-on effect to the global market. So in Crimea in 2014, when Russia annexed Crimea from Ukraine, they still kept the oil supply running. So we're assuming right now that it should continue coming into Europe. But with sanctions such as SWIFT, which we've seen pretty extreme, this may change and could have a further knock-on effect to the overall market. Now, Vivek mentioned earlier that companies were divesting from Russia. And I think Citigroup has been the one that people have been focusing on because they have a 5.4 billion exposure to Russia at the moment, and that's a 0.3% of the bank's assets. Now, when you look at the third-party exposure, that's 8.2 billion. And what people are thinking about now, or analysts are looking at, is how will Citigroup diversify from this? How do you back out 5.4 billion in assets? Arbden, an asset manager, is trying to back out 5 million already from the Rosneft. And they are really struggling to do that in the market. And this is due to the fact that they're getting poor offers because they have to pull out, and it's now down to the market participants to choose the cost. So I think this at the early start of the market is going to be the big impact. I mean, the equity side is going to be on trying to diversify and sell.
But when they're selling at such poor prices, I mean, obviously there's the investors out there who will buy, but is there the demand for such trades?
The interesting question, and I think only time can tell to see if Russia has enough capital to be funding in that. Now, Russia has stopped a lot of transactions coming out of the country, so I think companies will struggle to take money out. And there is a worry from oligarchs that they're going to have assets frozen, so maybe this would be used from the state bought back.
Has there been an effect on, issuance in some of the other markets?
So when we looked at CLOs, a recent news article from Global Capital had a source where they quoted that 70 CLO warehouses are open at the moment. So this is a great number, and it seems that the market is business as usual. Now, they might be trying to push up more deals before the Ukrainian crisis gets any worse. But it doesn't mean that there's no effect, because even though CLOs typically aren't that exposed to Russia, analysts at Robobank have looked at the cost per capita of sanctions, and they quoted $255 for the Eurozone and 178 per capita for the UK. So there will be a knock-on effect.
CLOs typically have performed well if we look at previous crises, and hopefully we see the same in this one. But as you said, it's still very early days, so many could be indirectly impacted.
Yeah, and you have to look at the companies that maybe they don't operate, or maybe their headquarters is not in Russia, but maybe they have an operation there, a lot of customers there, and that could have a pretty big impact on their performance.
And then if you look at the focus on ESG, which we're obviously going to talk about later on, but that also is going to have a huge impact on investors' decisions. There's a lot more positive screening now rather than negative screening. So I'm sure every financial institution are evaluating their policies for investment and divestment. So it'll be really interesting to watch.
With the 70 warehouses, I mean, hopefully they're able to get those through, and actually turn them into deals. If some of the banks are sitting there with these exposures on top of their, they're funding these exposures on top of their exposures to Russia directly, could be a pretty nasty situation for those guys. But in terms of the CRE market, that seems a little bit more positive.
Yeah. So real estate assets have always been kind of a hedge against volatility and jumpiness because they're long-term assets compared to like an equity market. So from this, it's going to take a while to see any effect on it. Now, in 2014, we saw investors from Russia and Ukraine during the Crimea crisis moving money out of the countries and into the US real estate. Now, they could also move this into other Western countries, and this is to get a more stable asset class, have their cash kind of kept out of the country. So we might be seeing this now, but Russia, as I mentioned earlier, have imposed a lot of sanctions on their people for moving any money outside the market.
Finally, with CMBS, I'm just assuming that there's going to be pretty limited impact from a fundamentals perspective. I mean, maybe you'll see volatility on the tranches.
So right now, we haven't seen much difference in the spreads, the pricing. So we're assuming that only because in the early days of the crisis and the war, that this might have a knock-on effect in the future, but it's something we're going to be really keeping an eye on and ensuring that every day nothing's coming up.
Right. So talking a little bit more about that, actually, you're saying that lending and spreads haven't really been affected in Europe. I mean, is it flat? Is it a little bit down, or what's happening?
So what we're seeing is European stocks have dropped and government bonds have rallied today on the nerves about the effect on the region's economy due to the invasion. So to put that a little bit into perspective, the Stoxx 600 share index fell 1.4%. Germany's extra DAX dropped 2.2%. France's CAC or CAC 40 fell 2%, and the UK FTSE 100 lost 0.6%. Russian companies such as Polymetal and Evraz, they've actually fallen out of the FTSE 100 because, of course, it's based on market cap. We've also talked about earlier that the price of oil has gone up. So the price of Brent crude oil has rose 3.9% to $101 a barrel. I mean, ultimately, again, not to reiterate the point, but we're still very early on in this situation. So it may have an indirect impact on the structured and commercial real estate markets, but all the signs so far are still quite positive. Again, time will tell.
I know, especially around oil, that I think it hit 105 last week, and that Biden was talking about releasing some strategic reserves of oil, and this is also with talking to other Western countries. So with oil prices fluctuating, we might have to see some intervention from governments to combat it.
Switching gears to securitization at large and away from the unfortunate war here, post-Brexit, we were hoping for the market to restart in the UK. Vivek, what do we anticipate here? Is something happening there? Is Solvency II an issue?
Yeah, absolutely. Actually, let's just take a step back. So for those that aren't familiar with the Solvency regulation, it's a directive in European Union law that codifies and harmonizes the EU insurance regulation. Primarily, this concerns the amount of capital that EU insurance companies must hold to reduce the risk of insolvency. Now, one of the benefits of leaving the European Union is not all regulations apply to the UK. We are different in many ways, but also very similar in other ways. And over the years, I've met with so many CMBS investors who have described solvency as a hurdle when it comes to investing in CMBS due to its excessive capital requirements. So as a post-Brexit dividend, the plan is to reduce the regulatory burden and free up billions of pounds to plough into new infrastructure projects in the UK. So the news was released over the last couple of days, and there's been a very positive outlook within the market. Insurers have lobbied for years for this change to the Solvency II regime, which requires them to hold too much capital and was way too restrictive in setting the parameters of which assets they could invest in. Therefore, we hope to see an increased investment from insurers in the securitization market, which will be great for European CMBS. For those that know me, you know I always fly the flag for the European CMBS market, but many are waiting to see specifically around the reduction in the risk margin and mounting adjustment that's applied to the discount rate by insurers.
I mean, I've seen firsthand that regulation has a huge impact on what insurance companies can and are willing to invest in. So let's hope that we see a change here in the CMBS market at least. So looking at some of these markets and sort of doing a review of performance and some of the metrics, Andy, you did some in-depth analysis both on CMBS and CLO. So maybe starting with CMBS, could you just give us the executive summary on what happened in 2021?
Certainly can. So we released a CMBS Year-in-Review, and if you haven't read it yet, email us at podcast@trepp.com and we can get you one sent over. So we know that 2020 was an extremely turbulent year for the market, and that's the structured finance market as a whole. But in 2021, we saw a great bounce back. We saw 2.4 billion euros issued and 2.8 billion pounds. This led to 16 deals with 7 euro denominated deals, 8 pound denominated deals, and 1 multi-currency deal. So it had tranches split both in euros and pounds. And this meant that we're already back to pre-pandemic levels, with Great British pound issuance succeeding the last 3 years.
Yeah, can I just jump in there actually? So if we take a look at European CMBS as a whole, for our listeners, European CMBS never really revived itself after the crisis. However, after a few years, we saw some issuance, so a few hundred million here. There may be a really low level of issuance there. In 2015, we saw a peak of issuance. However, when we really saw the comeback, which was in 2018, Morgan Stanley bought the first deal. It was backed by Finnish real estate, and that really saw the emergence back of CMBS. And actually, we've written about the resurgence. Again, shout out for any listeners to reach out to podcast@trepp.com and we can send you the pieces that we've published. But it's really great to see that even though when the pandemic hit, yes, the market stalled for a while and 2020 was a slow year for European CMBS, but having such a powerful 2021 and a great pipeline for 2022 is really great for European CMBS.
And what I want to highlight there, instead of pointing out in 2018, we had the resurgence in the market. There's about 2.7 billion in euros issued there, compared to 2.4 billion in 2021. But when you're looking at pound-denominated deals, there's 1.4 billion pounds issued in 2018. But in 2021, it was 2.8 billion. So we're seeing nearly a double increase. Now, when we're looking at the deals by country and looking at this by the deal count and not by the issuance volume, we saw 41% of the CMBS deals in 2021 were UK-based, with 35% being in pan-European, and these are the two biggest percentages. And what's great about that is we're seeing more cross-countries pairing. Now, that should lead to more diversification and be a better underlying pool of assets. And an industry that was really hit by 2020 was office and retail, along with hotels. So these places where everyone was working from home, not really going out, had massive impacts across all of Europe. But in 2021, we saw a resurgence in this market. And there's a deal I want to point out called Taurus 21-3. It's a European deal based out in Germany. And it has 64% office space and 29% hotel asset backed. This is great for the sector. And there's also a few other CMBS deals.
So I presume these are sort of properties that did well during the crisis, or they were able to survive and bounce back.
So this is a new issuance in 2021. I think it showed that investors are still looking at these sort of asset classes. And what we've seen during the European market news that we do is that in the office space especially, if offices have a shorter tenancy and high letting rates, investors are still going back to them and buying them. We also saw recently hotels getting refurbishments and redevelopments, especially in London.
Well, we're seeing the return to office now, right? We're seeing the back to normality. I'm hopping on a plane to New York in a few weeks, which I can't wait to see all the Treppies out there. So obviously there's going to be a hotel in New York that I'm going to be staying at. And a lot of people, a lot of colleagues and in the industry are starting to travel again. We're planning our conference schedule. So it definitely shows the performance of the office and the hospitality sector. And then of course you've got the industrial and the logistics, right? With all the huge spike in online shopping and all the retailers moving to online rather than physical retail space on the high street. So I think CMBS is showing a good reflection of all of that.
So I think we also have to highlight the logistics sector having a really strong performance throughout the year. And for us, 2021-1 was the only ESG CMBS. It was classified as being a green bond and under the Green Securitized Bond Framework because its cold storage facility was using 60% less energy than other conventional facilities. So this is great to be seeing that ESG is coming into CMBS and it's being recognized.
Absolutely. And I just want to highlight two other deals that came to the market in 2020 and 2021 that were ESG compliant. And the sponsor was Sage Housing, which is majority owned by Blackstone. And they are a for-profit social housing provider. And their goal is to provide affordable housing and energy efficiency. So this shows that having two deals backed by these types of properties, that obviously ESG is at the forefront of a lot of people's minds, and we'll see similar structured deals to come.
Europe has really embraced ESG and all the reporting around it, voluntary or not. There's a lot more data that seems to be available in Europe. But let's move on to the corporate CLO space now. Last year was a very good year in terms of issuance, record breaking in the US. So how did it look in the European market?
So in the European market, we saw 38 billion in new issuance. And we also saw 60 billion in refi and reset issuance. And what's interesting about those numbers is there's a reversal in trends compared to the previous 3 years where newly issued deals largely dominated the scene. The key driver for this was the interplay between the amount of spread tightening and the demographics of the CLO population. And 2021 also had the lower cost of funding. We saw that refi and reset market compared to 2019 and 2020 vintage had a 130 to 180 basis points compared to the 2019 and 2020, which were majority higher at around 170. Further, during the pandemic, a lot of CLOs were structured in the way that they had shorter refinancing points and reinvestment points. I think what's also been a great thing to see in the market is the CCC/CAA excess limit. So in 2021, we saw a decrease in its exposure metric from down to about 4.5. So in the BSL, the 7.5 is really the top limit. So it's great to see that this is going down, mostly because it just reduces that exposure to these sort of assets. And we mentioned ESG a lot. In 2021, around March time, SFDR came into play. So that's Sustainable Finance Disclosure Regulation. Now, this allows investors to compare sustainability profiles of different funds and really brings a lot more transparency to the market. Now, what this should do is also have a knock-on effect, having more investments going into ESG and going into the bond market, which will then fund the CLO market. So this is going to be great to see, and it's going to be very interesting now in 2022, especially with Ukraine and Russia, and seeing how different ESG metrics will be playing into that.
Back in November, Trepp hosted an ESG webinar, bringing in subject matter experts. For example, the head of ESG for fixed income at Bank of America, a CLO portfolio manager at Man GLG. And we talked heavily on the topic, and just taking a few key points from the CLO part of that. At the time, we saw that 44% of outstanding CLOs, European, now include US criteria. Andrew, to your point before, Europe is definitely leading that, but we're seeing that in the US, that CLO managers are joining the trend. So there was a Bank of England, Bank of America CLO research that was reported back in, I think it was October or November time, where more than 70 US CLO managers were signatories to the UN Principles for Responsible Investment. So we're seeing a lot of CLO managers, when they're bringing deals to the market, ensuring that those deals are ESG compliant, so to speak, because investors now are being more proactive and what's called positive screening when choosing their investments in this space.
Absolutely. And it's great to see, fundamentals improving across the board. US, it's been improving a lot this year and last year. So hopefully that means when we get through some of the issues, the market can go back to being gangbusters. So last topic about securitization. CRE CLO is kind of a mix between the two. And in the US, again, record levels of issuance in 2021, very, very popular along with SASB. It seems that CRE CLOs have kind of made their way across the pond. Vivek, can you give us some color?
Yes, I can. There's been a lot of excitement around it. Specifically in October 2021, Trepp reported that the first broadly distributed European CRE CLO transaction after the GFC in Europe was announced, and that was the Stars Mortgage Securities 2021-1. So this deal was a static CRE CLO securitization with the issuance of both GBP and euro denominated notes. And it's very good to see a different way of financing commercial real estate that is taking, I guess, the best of CMBS, the best of CLOs, but giving that more flexibility to the manager to trade loans in and out. And the time we're living in at the moment with all the uncertainty, I think that's a good structure to follow. We hope to see more European CRE CLOs being priced over the next year. And as it stands, there seems to be a very positive thought when it comes to CRE CLOs in Europe.
Excellent. So I love talking to you guys, but it's time to wrap this up. Let's do a vibe check. I think this is common in our other podcasts. We do want to hear person on the ground viewpoints, what's happening in the UK. From my viewpoint in the US, I'm mainly just really, really worried about the Queen. But Vivek, what's going on?
Well, the Queen is back to hosting virtual engagements. It seems she's on the road to recovery from COVID-19. She, as will all of us, be hopefully celebrating her Platinum Jubilee. So those in the UK, we get an extra bank holiday in June, which is great. It seems like everything's getting back to normal, right? So we recently lifted restrictions last week. There's a lot of people going back into offices. The pubs are full. People are going out for their beers and their burgers. The theatres are back. I'm looking at booking to go back into the theatre. Haven't been since pre-COVID. So yeah, the vibe is great and things are getting back to normal. Andy?
Yeah, I mean, I want to iterate some of the things Vivek said. I'm going to see Hamilton at the end of the month, and it's not being delayed again. So fingers crossed. It means that everything's back to normal.
Perfect.
I think some of our biggest issues we have right now are the London office are working from home because the tubes are striking again. So COVID looks like it's in the mirror when the tubes are all having these issues.
The tubes have a mind of their own. That's wild.
So yeah, it seems so they've really shut down the city. I've seen some photos there, people at Liverpool Street, and it's just queues winding down the street. So I'm glad we're back here. Yeah, just really Vivek. It seems that life's starting to get back to some normality.
Well, there's nothing more normal than a strike. So with that, we will close. Thank you very much to our producer, Haley Keene. Join the team later this week for our regular scheduled week in review as we look at what's happening during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening and stay well.
All right.